Hello, welcome to Finance 301. Um, this is Module 1, Introduction to Financial Management and Financial Markets, and I'll be reviewing with you today the Module 1 case. So this first module introduces you to financial management, which is, within an organization. How do we manage the finance department? How do we manage the financing of the organization, borrowing, raising money, structuring, accounting operations and that kind of thing. That's financial management, and then financial markets are the capital markets. That's where we raise debt and we raise equity, where companies raise debt and equity to go out and conduct business and purchase assets and do the things that they do. So the first question in the case one deals with the financial management side of things. And what are the roles of the various executives within a company? And the first role is the CFO. The CFO is the overall head of the finance department. They're the chief financial officer. So they're in charge of accounting. They're in charge of finance. They're in charge of everything that goes on on the financial side of the company. They sign off on the financial statements. So the accountants prepare, an income statement which shows the overall profit and loss of the company. They prepare a balance sheet which shows the assets, liabilities, and the equity of the company. So they prepare these various financial statements, and that's something that the accountants prepare every year, and the auditors audit it, and then the outside auditors of the company, and then the CFO signs off on those financial statements. The CFO sets overall corporate financial strategy. So the CFO of Apple is looking at, what mix of debt versus equity should they use to grow? Should they finance a new plant that they're going to build with debt? Should they finance it with equity? What are the capital requirements of the company going to be rolling forward? How much leverage should they use? Because you take on too much debt, then you're taking on too much risk, right? Because you've got too much leverage. So that's the kind of things they're looking at. They're trying to figure out what does the engineering department want to do? What does the sales department want to do? What do the other executives want to do? And how can the finance department service them by providing optimal, tax efficient, cost effective, and adequate amounts of liquidity. Liquidity meaning cash, meaning access to capital when the firm needs it. So we want to be there. We don't want to not be able to grow because we don't have the right type of financing, and we don't want to not be able to take on certain projects because the financing is too expensive. We want the cheapest possible financing that's liquid and available when we need it, and we need to plan all of that working together with the other departments so that we can plan for our financial plan for best case and worst case financial scenarios so that we have enough money to survive if things take a downturn, and the finance department is in there when there's a recession or when there's a problem with the business, looking at what departments make the most financial contribution to the company, which make the least, and where should the layoffs happen, where should the projects be cut back on if the company needs to save money. So financing is how do we help you grow, and how do we help you stay alive when things go south. So that's the CFO's role. They work with the other departments to determine, right, the best structure of the accounting processes, right, in addition to financing. So they're looking at, how do we when we sell a car to when we're Tesla and we sell a car, how do we account for that? Does the sales department have any influence over the accounting transactions? Because we really don't want them to. We want to have like internal controls. We want to make sure that the people who sell things don't also do the accounting, because they might fudge the sales to make a bigger bonus, right? So it's that kind of thing. It's kind of walking around the company looking at what everybody does and making sure that we don't we don't have exposure in terms of like internal control risk, in terms of risks within the company from our own employees or legal risks, things like that. Product liability, environmental liability. How do we kind of manage these risks, and how do we make sure that that we have objective, independent people looking at the accounting and the financial recognition of these risks so that we account for them properly. Because if the person who manages the factories is also responsible for reporting the environmental liabilities associated with the factories, they're never going to report anything because they don't want to admit that that they're maybe dumping toxic waste or they're leaking. There's some kind of environmental problem there. So you need to have somebody who doesn't work in that person's chain of command kind of looking over their shoulder, making sure that that things are being accounted for properly and recognized. So that's what the CFO does. CFO is there to make sure that the accounting is objective, that it's done properly, that it's efficiently structured, and that the financing, so the accounting and reporting has to be accurate and has to have internal controls on it. And then on the other side, the financing side, which is what we're more interested in, we have to be able to make tough decisions and have a game plan when things don't work out. And we also need to have enough liquidity there to help us grow when things are going well. Now, what does the controller do? So you always do things at the lowest possible level. So when you get asked a test question or exam question about what should the controller do versus the CFO versus the treasurer, you always want to answer the question at the lowest possible level, unless the question is saying, well, something about overall financial reporting, like if it involves financial statements being signed off on, or if it involves you know, overall financial policy and working with other departments and things like that, I would say that it's more of a CFO thing. If it's something that is done at kind of the ground level, it's just overseeing ground level operations, it's probably one of the other two. It's probably the controller or the treasurer. And so the controller is in charge of the accounting department. They oversee accounting for day-to-day business activities. They oversee internal management reporting of accounting, and they oversee the preparation of the financial statements. So the controller is preparing the financial statements. The CFO is signing off on them. So if you got a question about the recognition of, a liability, that's the controller's job. If you got an overall policy question, overall signature of the financial statements, that's the CFO. So the controller job is an accounting job. They do internal management reporting of accounting. That's like, all right, we got to understand, if we're GM and we're making cars, we got to understand how much labor is in one of our cars. We got to allocate labor costs to making the car. We got to allocate labor costs to making the fender, the hubcaps, the wheels, the engine. So where is most of our labor going? Where's the biggest cost of labor? And so if we're looking to automate or we're looking to make our operations more efficient, and it's not just labor, it's materials and other things. We've got to kind of understand where our costs are so we know where to focus on managing our costs. And so that's managerial accounting and reporting. It's efficiency reporting for management decisions within the company. It's also looking at, okay, where's our biggest opportunity for growth? And if we grow our revenue, right? If we sell a certain type of SUV that's going to be electronic SUV, and we can grow our revenue by making a sport utility vehicle that's purely electronic, in an electronic vehicle, that's great. But how much is it going to cost us to do that? Are we going to spend more money making those than we're going to be able to sell them for? Like, we need to understand, for each incremental car we produce, are our profit margins going up or down? And so, and how many are we realistically going to sell? Because you can always say, well, the more you sell, the cost per unit goes down. That's usually the case, but that's a bad assumption if you're not going to sell an infinite amount of cars, right? So you got to have an accurate estimate of your revenue in order to determine your expenses on a unit by unit basis. So it's kind of like planning for sales, estimating sales and things like that, and then determining how the costs will change with the sales, so that management can make decisions about, how much of X, Y, or Z product should we produce next year. So that's the controller. They're really working with management. They're providing financial excuse me. They're providing financial information so that management can make appropriate decisions about what direction to take the company in. Now, what does the treasurer do? So the treasurer is in charge of the finance department. So the controller runs, so the CFO is in charge of finance and accounting. The controller is in charge of accounting, and the treasurer is in charge of finance. So it's really the way to keep this straight in your head is CFO in charge of everything, controller is in charge of accounting, and the treasurer is in charge of finance. And everything is done at the lowest possible level. So if there's a basic this is a problem within the company, if somebody embezzles or steals money, it's not going to be the CFO that looks into that, because the CFO is kind of an overall, overall boss. They're working with the other executives to figure out setting strategy and setting direction for the accounting and finance departments to fit with the needs of the company. The treasurer and the CFO are going to the treasurer and the controller are going to resolve problems at the lowest level, right? They're like middle management in a sense. Depending on how big the company is, and smaller company, the treasurer and the controller are middle management, and the CFO is upper management, right? So what does the treasurer do? They're in charge of corporate cash and treasury management. So how much cash are we going to need how much cash do we consume every month, every quarter? How do we plan our cash needs in the future? Uh, how do we manage cash in an efficient way so we don't keep too much of it laying around, but we have it when we need it? How do we maintain relationships with banks and investors? How do we manage the corporate capital plan? What sources of financing is the company going to use to grow revenue, and how will the company use these sources of financing? So the controller was worried about, okay, if we grow the sales of the electronic SUV unit, um, how much is it going to impact our costs, and how much are we going to make per vehicle? How many do we need to sell to get to break even? The financial, the treasurer is looking and saying, okay, well, how are we going to finance the new electronic vehicle plant? How are we going to come up with the liquidity to produce these cars? What is it going to how is it going to impact our credit rating and our ability to borrow to finance other projects? Because if we spend too much on this project, it makes less money available for other projects, which might also contribute to the profitability of the business. So you got to make choices with a finite amount of resources as to what to allocate to. So the treasurer is putting together all the reports and all the information needed to make these decisions. Treasurer is not necessarily going to make the decisions, but they're going to, report out all the information about financing, all the plans, and they're going to have suggestions for upper management. And then, upper management in collaboration with the treasurer will make the decision on what projects to approve and which ones not to approve. But the financing for the projects is all arranged by the treasurer, and the company makes decisions about which projects to go forward with, um, based upon the other manager's input and the treasurer's input about the financial implications of everything. So, treasurer is in charge of the finance department. All right. So I think I've given you enough to answer the first question, or to give you the background to answer it. And now we're going to talk about real assets versus financial assets. That's another question here in the case one. And so physical assets, real assets are physical assets. They have an inherent physical value. So Dodger Stadium is a real asset. A Van Gogh painting is a real asset. A Credit Suisse 100 troy ounce gold ingot is a real asset. Intangible assets include patents, trademarks. They derive from a contractual right, so the right to do something. An option contract. An option contract is the right to buy something in the future at a price that we settle on today. So if I buy a call option from you on your house to buy it from you for $100,000, between any time and today and 2 years from now, that gives me the right for the next 2 years to buy your house for 100K. If somebody else comes in and offers you 200K for the house, you can't sell it to them. You have to sell it to me first. You have to give me the right of first refusal. So, I don't have an obligation to buy your house, but I have the right to if I buy an option. And of course, if you're going to give me an option, then you're going to want to get some money. You're going to want $5,000 or $10,000 for that option at a minimum, because you're locking up your house for 2 years. Can't sell it to anybody else. So that's how options work. And options are obviously, that's a contractual right. So that's a financial asset. A futures contract is like a notional bet. It's like, okay, uh, I'm gonna bet you I'm gonna put down $1,000, and I'm gonna use that $1,000 as collateral, and every point that the S&P stock index goes up tomorrow, uh, and if I'm long the contract, I'm going to get paid $50. And every point it goes down, you on the other side of the contract are going to get paid 50. But we're going to bet on $200,000 worth of S&P. We're only going to put, I mean, realistically, you'd probably put $6,000 or $7,000 down for a bet like that. So we're going to put 7,000 down, and we're going to bet on the value of $200,000. So basically, it's a notional contract, meaning there's no actual borrowing or lending of money. But what we're doing is we're creating an artificial amount of money that's bigger than the actual amount of money we have. And it's like gambling. It's basically just like gambling. We're going to make gambling bets about the size of a large asset, about the value of a large asset. And we're going to put down a small amount of money to finance that bet as like a deposit. And then if the bet goes against us by more than the deposit amount, we just forfeit the deposit. So if the S&P goes down more than $7,000 tomorrow, if 200,000 worth of S&P or 200,000 worth of stocks go down more than 7,000 tomorrow, and I put down a 7,000 deposit, I lose the 7,000. I'm out of the bet. But if it goes up, if it goes up 7,000, I walk away with 14. I double my money in a day. So that's the way futures work. It's like notional bets. It's like gambling. So anyway, and then you have money market accounts. That's like kind of like a bank account. It's just an investment in short-term commercial paper, short-term treasury bonds, things like that. So those are all like treasury bonds, stocks, bonds. Those are all financial assets. Those are all intangible. So are futures, so are money markets, so are options. These are all financial assets. So are trademarks and patents. So any intangible asset that involves contractual rights, a stock is a right to the shares of a company, a right to vote in a company and elect the board of directors, things like that, vote on major decisions. So that's a contractual right. It's not a physical asset. So even if the stock you invest in is a company that owns real estate, it's not a real asset because you didn't buy the real estate, you bought the right to control the company that owns the real estate. So that's an intangible asset. All right, so now we have value stocks versus growth. And if you want to invest in some value stocks, you can pull up the ticker on Yahoo Finance or on your TD Ameritrade terminal, RLV, IWD, or VONV. And so those are the RLV is the actual index. That's you might have to put a backslash in front of it. That's the futures contract and the cash index that is created by Russell, the Russell indexes, to keep track of a sample of 1,000 value stocks every day, what it's worth. The Russell 1000 Value Index. IWD is an ETF that invests in those 1,000 stocks. So IWD is a exchange traded fund that you can go out and invest in just like a stock, and it will invest your money in the 1,000 stocks in the Russell 1000 Large Cap Value Index. VONV is Vanguard's version of IWD. So IWD is the iShares ETF, and VONV is the Vanguard ETF. There might be a Schwab one too. There's probably more than just these three, but so the index is something that the IWD is an ETF. It's you buy a share and then they take your money and invest it in 100 stocks or 1,000 stocks. The VONV is also an ETF, and the RLV is the index that the ETF is based on. That's the actual ticker for the index. So that's some company out there like Dun & Bradstreet or Standard & Poor's is running a statistical tally every day as to what that index is worth at the end of the day. And then if you buy an option or futures contract on the Russell 1000, it's going to settle based upon what what Standard & Poor's or whoever owns that index tells you the value is. It was originally Russell Securities that owned these indexes, but I think they sold it off to another company. So Russell 1000 Growth is 1,000 growth stocks. So Russell 1000 Value is 1,000 large value stocks. Russell 1000 Growth is a sample of 1,000 large growth stocks, and the index ticker is RLG. The iShares fund that you can invest in is IWF, and VONG is the Vanguard version. Now the Russell 2000 is a small cap index. So what's the difference between the Russell 1000 and Russell 2000? The Russell 1000 growth and value indexes are 1,000 of the largest value or growth stocks in the country. The Russell 2000 small cap is a sample of all of the small cap stocks in the country, the like 2,000 of the smallest companies in the country. I think the largest company in the index has maybe a $4 billion market cap, so it's a $4 billion business. That's the value of the business, 4 or 5 billion, something like that. The Russell 1000, the largest market cap, is probably 100 billion or more, and the smallest is probably 50 billion, 60 billion, something like that. So the 1000 growth and value have larger companies. The small cap index is the smaller companies. Now the small caps as a group tend to be value stocks. They tend not to be growth stocks. So there are some small cap growth stocks. You can actually invest in a Vanguard Small Cap Growth Fund or a Schwab Small Cap Growth Fund, and they have indexes of those. But altogether, most small cap stocks are value stocks. And so the Russell 2000 index is like the broadest, most widely recognized small cap index, and it's predominantly a value index. Even though there's some growth companies in there, most of it's value. And why is that? You think about the oil business, that's considered mostly value stocks, right? Because it's an older business. It's it's kind of a business that's in decline. We don't think of When we think of growth stocks, we think of like tech stocks, healthcare stocks. When we think of value stocks, we think of banks and mining companies and you know, airlines to some extent. We think of the older airlines. We think of railroad companies. We think of oil and gas companies. And so, if you think about smaller oil and gas companies, there's a huge amount of small oil and gas companies in the United States. And so they make up a big chunk of the Russell index, as do banks. There's a ton of regional banks in the United States. Every little town in America, every little city in America has its own regional bank, its own local bank, and most of those are publicly traded. So there's a huge amount of regional banks in the small cap index. So taking that all into account, since the banks tend to be value stocks and oil stocks tend to be value stocks, and the IWM has a lot of banking and a lot of oil and a lot of oil field services related businesses. So that's what makes it more of a value index. Now, the NASDAQ 100 index is heavy in Apple, Facebook, Netflix, and Google. Facebook, Apple, Netflix, and Google. If you take the first letters of each of those companies, it spells FANG, right? FANG. And sometimes we'll say FANG M, Facebook, Apple, Netflix, Google, Microsoft. But um, and I'm sorry, it's Amazon. It's Facebook, Amazon, Netflix, and Google, right? But Apple's in there too sometimes. So sometimes you'll see FANG with two A's and an M for Apple and Microsoft. Sometimes you'll just see it as FANG, Facebook, Amazon, Netflix, and Google. Um, so those are growth stocks. Amazon's a growth stock, Facebook's a growth stock, Netflix, Google. Also, Snapchat's a growth stock. So growth stocks are stocks that they have high earnings growth, they have high revenue growth, they tend to be tech companies, healthcare companies. And so the NASDAQ 100 index is largely a growth index. It has value stocks in it, but the weighting of the index skews in favor of growth because the top 5 or 10 companies in the index are the FANG companies and Microsoft and Apple, right? So the S&P 500 index is a large cap index that takes the largest of the growth and value stocks from the Russell 1000 and reduces them to a list of 500 stocks. So the S&P 500 has companies like Raytheon in it. It has companies like Boeing in it, which are more value oriented, and it also has Facebook, Amazon, Netflix, Apple, Google, and Microsoft. So it has the value stocks and the growth. So the S&P 500 is a mix of growth and value. It's a really good diversified index. If you're looking for a set and forget investment strategy, and Warren Buffett has said this many times, the S&P 500 is a great place to start because it's a list of the largest, most successful, kind of the larger. There's a couple ways we measure the risk of an investment, and one of them is just how large and well diversified is the business. And the businesses within the S&P 500 are bigger businesses. They're better, they're well-established businesses. They have earnings track records. You have to have been a public traded company for a minimum number of years to even get into the S&P 500. So these are the highest, some of the highest quality stocks in America, are like some of the highest top performing stocks. And so the index has done exceptionally well over time because regardless of whether value stocks are doing well or growth stocks or tech stocks are doing well or biotech isn't or whatever, the S&P is a diversified index in all the different sectors of the economy, and it's agnostic. It has no opinion about growth being better than value or whatever. So it's very well diversified, and I think since 1929, it's returned something like 6.7% per year after taking out taxes and inflation. So it has higher returns than inflation and taxes by almost 7% over a 100-year period. So that's really, really good. And so even if you go back before 1929, it averages out to close to 7%. So even taking into account the 1929 crash, where the S&P went down something like 90%, it's returned really good returns over time. The Dow 30 index is more of a value index, and it's a heavy industrial type of index. So there's a lot of Boeing, a lot of your big heavy industrial type stocks, Ford and GM, that kind of thing. A growth stock has strong revenue growth, a high PE ratio, and it often operates at a loss and usually doesn't pay a dividend. So a lot of the top growth stocks in the country have never turned a profit, and they tend to be high growth areas. They're new businesses, new healthcare technologies, new robotics technologies, new software technologies, new hardware technologies. Those types of things tend to be a growth type investment. Now, a value investment is a company that's been around for a long time, a company that's been around for 50 years, 100 years, or at least 20 or 30 years as a public company, and they are maybe they've seen better times. Maybe their price is down a bit from where it's been in the past. And if you look at the oil companies, if you look at a company like Transocean, that was a $100 stock 10 years ago. Now it's $3 a share. That's a value stock. That's a company, they do offshore oil rigs. So people think oil is going away as an energy source. So that stock is way down. It's valued at 3% of what it was 10 years ago. So that's a classic value play. And it has a low price to book ratio because the assets of that company it still has a lot of assets, you know. And so if you look at the book value of its assets, net of liabilities, that's higher than what the market cap is of that company, because because they still have a lot of assets. It's just that the stock market isn't valuing those assets as much because they don't think those assets are going to be useful for much longer. They think we're going to stop using oil as an energy source. So that's a typical value stock. The market has an opinion on, yes, this company might have a lot of assets, but they're not worth much because the business is in decline. The industry is becoming obsolete or is in decline. Now, financials tend to be in the value category, even though they're banks, they're fairly solid companies, but they tend to trade at a lower price to book ratio because the bank isn't going to grow by 50% a year, right? So it's not going to be in the growth category. It's going to be in the value category. So, and they tend to pay a dividend. A lot of value stocks have earnings, they have an earnings history, and they pay dividends. And I think a company like Transocean might actually have losses because they're in the oil business, they might be losing money, but they have a low price to book ratio, meaning their value of the company isn't much more than its assets. If you look at a company like Tesla, it's valued at 100 times of what its balance sheet assets are. You look at a company like Amazon or Amazon or Facebook or Netflix, they don't have a lot of assets in their balance sheet because they're technology companies and they're valued at a big multiple of what their assets are. Like a Ford or a GM, even though they make cars just like Tesla, they're valued at much lower multiples of their earnings and of their assets, right? Because the market isn't assuming that they're going to transform the whole economy. It's just assuming that they're going to make X amount of cars per year and sell them for a profit. So it's a different assumption behind valuing that business. And so the ratios tend to be lower, which if you have a lower ratio of your price to your book value or a lower ratio of your price to your earnings, value investors view that as a margin of safety. They feel like, okay, if my company's valued at 100 times earnings, how do I, I can't even make sense out of that because the typical company is valued at maybe 10 to 20 times earnings. So like, that's like a 5% return, a 5 to 10% return is what that company's expecting if it's valued at, you know, 10 to 20 times earnings. But if we're valuing it at 100 times earnings, that means, our earnings are only going to generate a 1% return if something's valued at 100 times earnings. And so the rest of that return isn't going to be from earnings, it's going to be from growth. And so we're assuming that the economy keeps growing, that business keeps growing. We're making a lot of rosy assumptions to justify that valuation. And if any one of those assumptions goes wrong, the company's worth a lot less. But a company that's already being valued at 10 times earnings, it can't go down much more because the earnings are justifying the value. So a value investor is saying the cash flow, the assets, if we sold off, even though this company's losing money, if we sold off all the assets, we'd get more than we would than what the market is valuing the stock at. So if we just liquidated the company, it'd be worth more than the stock price. So that's a safe investment in the view of a value investor because they feel like they can liquidate the whole company. Even if the company just blows up, they'll still get some value per share that's greater than the current market value because the market's just undervaluing the business. Whereas a growth investor is saying, yeah, the economy is going to keep growing. Even if the economy shrinks, this particular sector, the software as a service sector or the virtual reality sector or whatever, is going to grow at a faster rate than the rest of the economy. And so even though these companies valued at 100 times earnings, its earnings are going to grow by 1,000% over 10 years. So it's really valued at 10 times earnings on what the earnings are 10 years from now, right? And a value investor is saying, well, but what if things don't change that much and some of these older businesses and older sectors of the economy retain some value as justified by their earnings. So that's really the thought process. You're looking at a few different things that can make a value stock versus a growth stock. Value stocks usually they pay a dividend, usually they have earnings, they trade at lower earnings multiples, they trade at lower price to book value multiples, price to book ratio, and you can look those ratios up right on Yahoo Finance or on your broker's website. If you look at financial statistics, it'll show you the price to book and the price to earnings. Average price to earnings of a stock right now is around 20. And so if it's under that, it's probably value. If it's over that, it's probably growth. If the price to book ratio is like, single digits, under 3, it's probably value. If it's, 5 or 10, if it's more than 10, it's probably growth. So that's kind of how you make these decisions. And if the company doesn't have, so some companies, a lot of growth stocks don't have earnings. Some value stocks don't have earnings either. But the way you tell the difference is, the price to book ratio is, if it doesn't have earnings, usually the price to book ratio is like less than 3, maybe less than 2, or even less than 1. That's how you know it's a value stock. If it's a growth stock, the price to book could be 5 or 10. So anyway, that's just some general ways to figure out whether you have a value or growth. And you can, the main thing is technology is generally value. I'm sorry, technology is generally growth. Healthcare, biotech, things like that are generally growth. Biotech, um, robotics is growth. Value is like semiconductors are value because it's an older technology. Microchips, like Nvidia would be a growth stock, but Intel would be a value stock because Intel makes kind of general chips that are used in a lot of different things. And NVIDIA makes chips that are used in self-driving cars and virtual reality and things like that. They make graphical processing units. So that's a more advanced type technology. So some chip stocks are growth, some are value. If they make memory, they're value because memory is boring, right? But if they make VR chips or something exciting that's new, that's their business focus, then they tend to be more of a growth stock. So what is GARP? GARP is growth at a reasonable price. That blends aspects of value and growth. So they're saying, yeah, we want to buy growth stocks, but we only want to buy the ones that are trading at less than 20 times earnings or less than 50 times earnings or whatever. We want to only buy the ones that have earnings. So they want to make sure they're paying a reasonable amount for that growth. They're not overpaying for it based upon the financial ratios. Value investing looks at a lot of financial ratios. the dot-com bust of 2000, 2001 involved the massive collapse in the value of growth stocks. So your growth index lost, 70, 80% of its value, a lot of the growth indexes during that time. The value indexes only lost 20% or 30% of their value. So value outperformed growth, from 2001 to 2007, but it didn't do it by going up more than growth went up. It did it by going down by less. Um, for the most part. But that doesn't mean that all crashes have to be led by growth. You can have a market crash that involves both growth and value, or you can have one of those sectors take leadership over the other. So you just have to watch out that a value investment over time isn't a safety net really against financial collapses and things like that. But neither is a growth portfolio. It's that's why the S&P, right? The S&P has beat everybody over time, all these other indexes for the most part. And the way it does it is it invests in both. So, and I think that's probably good advice for most people, that both growth and value have their place in a portfolio. And you should have a weighting of both. Now, if you want to get into discretionary investing, you might say, well, growth is overdone. And so I'm going to concentrate more of my money into value for the time being until growth sells off or becomes more, relative to history, more reasonably valued, you know, compared to growth, compared to value. And so if that happens, then I'm going to allocate more money to growth. So I'm going to study the spread between the growth and the value. They call that the VG spread. The spread between growth stocks and value stocks is called the VG spread. And that spread is at its most extreme right now in its history. It's the outperformance of growth stocks over value stocks is ridiculously high. It's even more ridiculous now than it was during the dot-com bubble. So that means that value stocks are have underperformed growth stocks since around 2009, 2010 by a larger percentage than they underperformed during the 90s, during the dot-com bubble, when the last time growth really outperformed value. Now, some people take that as, well, sell all your growth stocks and put everything into value because value is going to catch up with growth. Other people take it as just growth is a superior investment to value, and you should put all your money in growth. Um, what's proven right over, I mean, these mismatches between value and growth have happened many times throughout the history of the markets. And what's proven to be right over the past 100 years or so of this has been a portfolio with a little bit of both is probably the best way to go. And that's the S&P, right? So you can but you can take either side of that. You just, if you want to invest all your money in growth, you just got to be, prepared for a meltdown. And if things do melt down and that ratio reverses, have a game plan as to what to do, how you're going to manage your risk. And if you go all in on value, just be prepared that you might be wrong about that, and you might have to play catch up with risk, with growth over time, if some of these industries just turn out to be obsolete, right, and just go away. So anyway, so you always got to be prepared for the idea that you might be wrong, no matter how convinced you are of an idea, and you have to be flexible. I think that's one of the big takeaways that from investing. Nobody's right all the time, and you just as long as you have mental flexibility, you can survive. Um, all right, so more on value versus growth characteristics. Banks, insurance companies, and other financials tend to be value stocks. Older industries like railroads, manufacturing, and base materials like aluminum, copper, they tend to be value. Your software, pharma, robotics, that's growth, AI. Um, Western Digital, Intel, and Taiwan Semiconductor, Texas Instruments, Micron, and Cisco, they're all value, right? They're all tech companies, but they're all value companies. Cisco does telecommunications. The other companies do, you know, microprocessors, CPUs. CPUs are value. Uh, and the GPU stocks like NVIDIA that make kind of the software that runs AI, runs robotics, runs self-driving cars, virtual reality and gaming systems, that's a growth stock because it's in newer areas of semiconductors, not the older. But there are semiconductor stocks in the Nasdaq 100 that are more value type stocks. So, these indexes have a blend of things in them. Some banks in a high growth area like Austin, Texas, or Phoenix, or an online fintech banking company like Rocket Mortgage, they might be growth stocks. Like Rocket Mortgage is a tech-driven bank. So even though I said most banks are value, some banks are growth because they're in growth areas of the country. Their business is based in a growth area, or they're on the internet, and they're really a software company and a bank. Some tech stocks like Apple are really value stocks because like Apple has a very low P/E ratio, it pays a dividend, so Apple's really a value stock. Some people still consider Apple to be growth. Some people consider it to be value. There's debate about what kind of company Apple is. It's leaning more towards the value, and I think Warren Buffett invested in Apple recently, and so there you can see that if Carl Icahn and Warren Buffett are investing in stocks like Apple, which I think they both have, they're very famous value investors. Then you can see that you can see a value stock that's taken on characteristics of growth. I'm sorry, a growth stock that's taken on characteristics of value. Now, 40 years ago, Intel was a growth stock, and 40 years, Google will probably be a value stock, right? Because it's going to become like a telecommunications company, like just like the utility companies. At one point in time in 1910, a utility company was a growth stock because not every house had wiring. But now that everybody's using Google, they've grown as much as they can grow at some point. Maybe not quite yet, but eventually. And then they become more like a type of communications company. So they're going to be characterized as value. Uh, so the software, and the internet business is becoming in a form of infrastructure like utilities. That's true of Facebook. Over time, they're migrating more towards like a telecommunications type business model versus a growth business model. And some of the infrastructure and software is still growth. Software as a service, companies like Square and different cloud companies, DocuSign, that's still growth. AI and hardware for self-driving cars, those are still growth, right? So there's aspects of the tech business that are growth, and there's aspects of it that are more value oriented. All right, so that's just all a bunch of theory, and you really don't need to study the past few slides. We're talking about value versus growth. I mean, you don't need to study them in great detail if you don't have time or if you don't want to. Your focus can just be on, okay, these are the basic characteristics of a growth stock. It tends to be tech. It tends to be, low PE ratio, may not even have earnings, tends to have a high price to book ratio. The characteristic of value is that it's low price to book, low PE, pays a dividend, usually, and that it tends to be in an older business like railroads or financials. Now, they don't have to have all those characteristics to fall in one category or the other, but they usually have some, and they're usually prominent in having those characteristics. So now that you know that distinction, how do you find out? They ask you in this assignment to find out the PE ratio, the dividend, etc. of a stock. How do you do that? So I just went to this URL up here. I highlighted it in yellow, finance.yahoo.com. If you just type in finance.yahoo.com into your browser, this portal will come up, and there's a little looking glass there. There's a search bar at the top. You type in a ticker of a stock. I typed in PNC, and this is what came up. It has a summary screen for PNC. And right under the big price there is 191.52. That's the current share price. Below that's summary, company outlook, chart, conversations, statistics, historical data, profile, financials. So if you want to see the financial statements, you click on Financials tab. If you want to see a profile of the business explaining what the business is all about, you click on the Profile tab. If you want to see statistics, like if you want to get into like the price book ratio, a lot of the more esoteric financial ratios and statistics, you click on the Statistics tab. It'll tell you, any weird ratio you want to know. You click on the Summary tab, which we're on right now. It's the first thing that pops up. It has the PE ratio there. I have highlighted that in yellow, and it has the forward dividend yield. So that'll tell you the dividend, the PE. It'll tell you the 52-week range. So you don't even need to look at the chart to figure out the 52-week range. It's right there. It's 101.58 to 203. So you've got your 52-week range, and you can use the chart. This is a one-day chart. If you click on 1 year, or if you click on the chart tab and pull up a 1-year chart, you can see where the stock's been over the past year. So if you want to research stocks, you can use Yahoo Finance. You can use, MarketWatch.com. You can use Google Finance. You can use TD Ameritrade. TD Ameritrade has an amazing charting and financial research platform. I think you can set up a free account there. It's called Thinkorswim. So that's a great tool. And you just want to, this is how you're going to gather information to answer the case one questions.